Welcome to the Confident Retirement Podcast. How confident are you when it comes to life's biggest money decisions? What is real financial peace and how can you get it? Kris Flammang and Mark Peachy are the founders of LPF Advisors in Sarasota, Florida. They bring together the brightest minds to show you how to have a more confident financial future. They empower listeners with common sense concepts and financial wisdom. And now, here are your hosts, LPF Advisors. Hey, everybody. Welcome to the Confident Retirement Podcast brought to you by LPF Advisors. I'm your host here again, Kris Flammang, and I'm doing a follow-up episode to the one from last week where we talked about different options for excess cash that you might have, or what we call cash reserves. So you'll recall from last week, we talked about savings accounts, money markets, money market funds, and other options that you have for your excess cash. So I want to do kind of a follow-up on some things that you could consider as being good options for excess cash that have general relative safety, not typically considered a risk type of investment. So we'll go through each one. I'm going to talk about T-bills. I'm going to talk about I-bonds. I'm going to talk about municipal bonds and also municipal bond funds. All these are types of investments that you can use to generate income, usually would have much higher interest in the current environment, more so than just keeping things in a savings account. That would generally minimize your risk. However, each one of them has its own unique characteristics and that make them suitable or maybe not suitable for different types of investors. Now, I do want you to know that I'm going to go through these options and explain them. I'm not giving anyone in particular investment advice. You need to consult an advisor, get the information, make your own decisions. Also, everything that we're going to talk about today does not have what's known as FDIC insurance. There are some assurances that it's have, and I'll explain those, but it is not in the realm of FDIC insurance. The stuff I'll discuss today still has relative safety compared to other investments you could use that carry market risk, but I wanted to make that distinguishing remark. Okay, so let's start with T-bills. T-bills are short-term government bonds. They usually have a maturity that's less than 1 year, and they're issued by the U.S. Treasury Department, and they're considered one of the safer investments available. The main advantage of a T-bill is that they are virtually risk-free because they are backed by the full faith and credit of the U.S. government. All right. However, the downside, especially in the past, is that they offered a relatively low return compared to other types of investments. And T-bill rates have historically been lower than the rate of inflation, which means that you might not be able to keep up with purchasing power. Now, since the Fed has raised interest rates so much, the rates on T-bills have come up quite a bit. So now they're in the conversation of being pretty attractive. They do have a website, the Treasury, it's called Treasury Direct, where you can go on there and get rates for the current auctions, see what they're paying for the different terms that you could do. But the main downside is it might not be able to keep up with inflation or purchasing power. And how you might define purchasing power is basically just what $1 will buy today compared to in the past or maybe in the future. And the example that I love to use when I was growing up, if you went to a Coke machine and stood in front of that and you wanted to get a Coke, I remember very vividly that it cost 50 cents, 2 quarters to put in there and get a Coke out. And as we all know today, when you go to a vending machine to try to get a soda out, depending on where you live, it is definitely not 50 cents anymore. It's well over $1. And in some cities could be over $2 or even $3. So that rising cost means that what 50 cents used to buy no longer pays for that same thing because the price of it has gone up so much. And so you have lost the purchasing power over time. Okay, I hope that helps. Let's move on to I-bonds. I-bonds are savings bonds that are also issued by the Treasury Department, and they have a fixed rate of return that then is adjusted up for inflation. So that means there's like a base level return, which is generally very low. And then whatever inflation or the CPI increases, that is an extra boost or return that you get on top of the base rate. So those got very popular in the last year or so when inflation started going up a lot. Because inflation was high, the returns on those I bonds was jumping up in some cases the 8 to 9% range. Okay, so this makes them a good option for investors who maybe want to protect their purchasing power over time if they're worried about inflation rising. And it's linked to a rise or a decline in the CPI. The downside of I bonds is they historically also have pretty low rates of return compared to other types of investments. Up until a year ago or a year and a half ago, they really weren't in the conversation because the rates were so low, and CPI or inflation was not a concern and hadn't been for decades. But that's changed recently with the costs of things going up so quickly. So those may be a consideration. The other limit on I bonds is that there are limits on the amount that you can invest in them. So there's a maximum amount that you can put in on a yearly basis. And you generally have to keep those invested for a pretty long time. So the liquidity on those isn't great. All right. So you're going to want to consider that. Let's talk about municipal bonds now. These are issued by state and local governments to finance public projects, schools, roads, hospitals, airports, maybe a stadium or something like that. They are exempt from federal income tax, means no federal income tax is paid on the interest. And they also may be exempt from state and local taxes, depending on where you live. Now, this makes them a good option for people who are in high tax brackets and they want to reduce their tax burden. However, the downside of municipal bonds is that they may be subject to something called default risk. This means there's a chance that the issuer, the state or municipality or local government, may not be able to repay the bondholder, being you if you bought a municipal bond, due to them not being able to collect enough in taxes or falling on hard financial times. And usually municipal bonds typically have a lower yield than other types of bonds. That's another discussion for another time, due to their tax advantage. You also have to hold them to maturity. So if you hold them to maturity and they don't default, then you're in a good spot. You get the money back and you get to keep the interest that you collected over the time that you held it. And generally, because municipalities and states and local governments can collect taxes, usually the default rate, the rate at which they fail, is pretty low compared to other types of bonds. So it makes them a pretty good option. But again, you'd want to consider the risks and see if you're comfortable with that. Now, finally, let's talk about municipal bond funds. These are mutual funds that are made up of municipal bonds. It could also be an exchange-traded fund. So these invest in a diversified portfolio of municipal bonds. You don't own the bonds. You own shares of the fund. The advantage of investing in a municipal bond fund is that it provides diversification because there might be hundreds or thousands of bonds in there. You also have professional management. And the other thing is you have liquidity. So you could get in and out of that municipal bond fund whenever you wanted, where with a municipal bond, you would have to hold it until its maturity date, until you could liquidate it or take it out. If you tried to sell it early, you might get more or less than what you paid for it. Okay. Now, the big downside of municipal bond funds is they are subject to interest rate risk. So if interest rates rise like they did over the last year, the value of the bond fund could decline. It's an inverse relationship. And in addition, the municipal bond funds may also be subject to default risk because they own municipal bonds that are also subject to default risk. So just like an individual municipal bond, the bond fund also carries that danger, although it's relatively low. The other thing is if you buy a municipal bond fund for one price and you sell out of the whole fund or part of it at a higher price, then you could also have what's called a capital gain, and there might be some taxation on that. All right. So in conclusion, each of these investments has its own unique advantage and disadvantages, and that depends on your situation. T-bills and I-bonds are relatively risk-free, but historically have offered lower returns. Depending on the economic conditions, those things have gotten a little more attractive over the last year and a half. While municipal bonds and bond funds have tax advantages for people in high brackets, but they may be subject to default risk, and you may have a loss of principal there or even a reduction in the amounts that you invested because of what's going on with interest rates. So I hope that kind of clears up the differences between those and see how they might work. I thought it would be helpful to give kind of an example strategy if you had some excess cash. And I'll use an example, let's say $500,000 where someone has maybe received an inheritance or a windfall or saved up that money going into retirement. They wanted to do something other than just leaving it in a savings and checking account. An example would be is maybe they could do several T-bills of different maturities, say 13-week or 26 weeks. They could also do a 1-year CD at their bank, which would get FDIC insurance up to that $250,000 limit. In addition to that, they might use a money market fund to provide some liquidity, also a very competitive return. But if they need access to the money, they could take it out. And then maybe for something they didn't feel like they needed for a longer period of time, they could use a municipal bond, either a couple of them or a ladder, or maybe a municipal bond fund to get some tax-free income if they were in a higher tax bracket. Of course, that's not a suggestion, but that's just an example of how you could tier it or do different products with a amount of money that you might invest in excess of your checking and savings accounts that you use for operating. So it is important for people as investors to consider what they're trying to accomplish with their money, what their appetite for risk is, their tax situation, and think about the risks. I always tell people, if you work with an advisor, make sure to consult with them. You might be thinking one way, they may have some other ideas. Okay. So as always, I hope this was helpful. I want to thank everybody for listening to the podcast this week, Confident Retirement Podcast, where we're hoping to raise the retirement confidence of everyday people to another level, one show at a time. If you have any questions or comments, please feel free to reach out to us. And I hope you'll consider subscribing to the podcast for other informative episodes like this in the future. Be well, take care. We'll talk to you next time.
You've been listening to the Confident Retirement Podcast with Kris and Mark from LPF Advisors. For more information on them and retiring confidently, please visit lpfadvisors.com. If your ears are pleased and your mind is now at ease, do share the program with your friends and subscribe wherever podcasts are found.